So I'm just going to take care of the introduction, and then we're going to pass it off to Mark Valerio, who's a partner in our commercial practice, and Mike Vollmer, who's a principal in our not-for-profit practice, to talk about the first and second draw PPP funding. And then myself, Lynn Musunski-Keck, a partner in the tax practice, along with Rob Nasso, who's a partner in our not-for-profit group. We'll be looking at the employee retention credit and really stressing through a case study of why it's become a little bit more complicated. And then we're going to end with Jeff Haley to talk to you, who's a partner in our not-for-profit group, to talk to you about the Shuttered venue operator grants, which are significant, and I would almost say better than PPP funding if you can qualify. And then we're going to try to leave the last 20 minutes for some Q&A. But again, as previously expressed, we will try to take some questions during the actual presentation if we're noticing we're not being clear about something. So just before I pass it over, can you flip to the next slide? We just want to remind everyone this is still relatively new. I know it's hard to believe it's January 13th. I feel like, where did the half of January go? It's already gone. But this was passed on December 27th. There were some significant incentives in the program. But why I want to just caution everyone is if you haven't heard already, President-elect Biden is looking to fund another major stimulus bill. And because of that, while we are getting our ducks in a row related to the act that was passed on December 27th, we are anticipating, again, what I would call the goalpost could potentially move in this another stimulus bill that will be passed. It is on his docket for the first 100 days. I just saw BNA, Bloomberg passed something off that he might have slower appointments to his cabinet and a variety of things because of other things, as you all know, happening within Congress right now. But it is something that we would caution you that just like this stimulus bill may have changed the way you apply your funding for your first PPP draw, this next stimulus bill might also cause you to change the way you use your funding. So again, it's been our mantra. We do caution you. You have 10 months before pushing in and having to ask for PPP debt forgiveness. Unless you absolutely have to, I think I would hold off and make sure you understand not only the current bill that's been approved, but any potential bill going forward. So that's just our caution before I toss it over to Mike and Mark to talk about the PPP funds.
All right. Mike and I will cover first draw and second draw PPP loans that were as revised by the most recent bill. Starting with first draw loans, there was money left, and then there was also more money allocated for first draw loans in this new bill, and it opened up the ability for PPP borrowers to request an increase in their initial loan amount based on certain situations. If they had applied if you have applied for the first round loan and you didn't accept the full amount that you were entitled to, you may request a modification to increase the amount of the covered loan to the maximum applicable amount. If you had returned it, think back to May when various FAQs were coming out related to the good faith certification and need. Some people had returned their loans. Some people weren't sure they were going to be able to reopen or use their loans. There was a lot of rules changing and goalposts moving, as we talked about, and people paid it back. Now they've created a method for you to go back and capture that, work with the lender, and they've provided lender guidance as well on how to report those and issue those loans to right-size them. And then the third bullet here relates to, for partnerships initially, again, PPP opened pretty fast and furious on April 3rd, and guidance for partners to use their income, to use their draws, their allocation of income for purposes of calculating their PPP loan was not issued until the middle of April. Therefore, many loans were distributed before they had the ability to use that income, which amounts to $20,833 for each partner that has $100,000 or more of income allocation. Guidance was put out, I believe, on May 18th, on how to upsize your PPP loan, but obviously for various reasons and with the passage of the PPP Flexibility Act on June 5th, a lot of borrowers did not really have the ability to go and get that upsized loan. So the new law provides guidance to the lenders on how to right-size those loans. And just keep in mind, if you don't, your second draw PPP loan could be limited if you don't go back and fix your first draw PPP loan first. And there's some thought that you may be precluded from a second draw PPP loan if you don't first fix your first draw PPP loan. So keep that in mind as you move forward. The eligibility requirements for the second draw PPP loans, I think most are fairly well versed in this by now, but the 500 employee requirement was dropped to 300 or fewer employees. You have to demonstrate that you had a 25% reduction in revenue in any quarter in 2020 related to the same quarter in 2019. These are calendar quarters, to answer one of the questions we received already. You can also show, the SBA guidance indicates that you can show an annual reduction as well. And then you have to have received a first draw PPP loan, not just had the right amount, like we just talked about on the last slide, but have received one. And then you have to demonstrate that you have used or will use the full amount of the first draw PPP loan on or before the expected date that your second draw loan is dispersed. And this has certainly raised a lot of questions. Lenders have told borrowers, some have sent some mixed messages as we were awaiting the SBA guidance, but the SBA guidance in the interim final rule makes it clear that you don't have to have received forgiveness. You don't even have to have applied for forgiveness, but you have to have used the full amount. And I don't know if you have to evidence it, but you have to expect full forgiveness on the loan. And correct me if I'm saying anything wrong.
No, Mark has it hit it right on the head. I just saw some question fly through that says, do I have to include my prior PPP forgiveness in my income when calculating my gross receipts test of a 25% or greater decline? And the additional SBA guidance has made it clear that you do not have to include that debt forgiveness. And the other thing I would just point out from Mark's previous slide is when they talk about you use the full amount of your first draw PPP loan, we know at least two fact patterns are if you got approved for 800 and you only took out 6, you got to go back and use that other 200,000. And then the alternative would be if you the second one. If I can't remember what the second one was. What was the second one? You didn't take it all, or
you didn't have the ability to get it all.
Right. So those first two bullet points on the previous slide must be maintained. But as Mark said, I'd reiterate, you do not have to apply for debt forgiveness, nor are we recommending you apply for debt forgiveness at this time in order to go after the second draw.
Okay.
Do you guys cover that? For your second draw, you can use either the 2019 salaries or the 2020 salaries, depending on what might give you a favorable result. If you're going to the same bank and you're using the 2019, you won't require any additional documentation.
All right. With that, I'm going to hand it over to Mike to talk about some changes that impact both first and second draw PPP loans.
Thank you, Mark. So the question is, are there additional expenses now that you can use your PPP 1 or 2 funds for? And yes, there are. They have defined them, as you can see, covered operations expenditures. We talk about software, cloud computing for HR and other accounting needs. You also have the ability to use them to cover property damage costs. So if you are in an area that had some disturbances during the year and you had damage that was not covered by insurance, then you can use your PPP funds to cover those costs, as well as cover supplier costs. If you had a contract, purchase order, et cetera, in place, and you had to still pay for those goods, you can use some of the funds for those supplier costs.
Okay. I'm seeing a lot of questions about eligibility and calculation of amounts. Generally, much of that guidance is the same as it was for the first draw loan. So we're highlighting the changes here.
Right.
But anything that's not on here, generally the guidance is the same.
Yeah, they didn't go back and say you can't use anything that you could have before. They've added to it only at this point.
And the other thing I saw, if you didn't go after your first PPP loan, that doesn't prohibit you from going after your first PPP loan now, but it wouldn't be related to the second draw PPP loan. It would still be related to the first, and it actually might be more advantageous, right, because the first doesn't make you show this significant decline in gross receipts of 25% or greater, and it has a little bit more liberal surroundings regarding the employee count. So again, we're just trying to talk about the differences. But you still have the capability, if you qualified under PPP, especially for the 501c6 that just got added, that you can go after that as well.
Thank you. So another item that you can now cover is these covered worker protection expenditures. So if you had to put up barriers, you had to put up plexiglass barriers, things like that, you can now use your PPP funds to cover some of those expenses. Because of this new bill. A point we want to just emphasize, you still have to use at least 60% on your payroll expenditures, whether it's your first or second draw loan. And the beautiful thing about this act is that they made this both retroactive and prospective, so you can use it on any PPP loan you already had, as long as you obviously have not already filed for forgiveness. In that case, that ship has sailed. That's all done now for you. But if you've not filed for forgiveness yet, you can go back and include those costs, and you can do it on the going forward basis also.
Now, I see a question here about 501c6 not having to have had a first draw. That is correct, but I think the technical answer is that your loan will be considered a first draw loan, but there's nothing to indicate that you would be eligible for a second draw loan, just based on the timing of it all right now, because you have to have applied and used it all, obviously. But you have to have applied by March 31st. It almost seems impossible to have applied, used it all, and then applied for a second loan and have a new cover period.
I would agree. I'm not sure how you would possibly be able to do that based on timing, like you said, Mark. Another item that they put into this bill is you can now choose anywhere between an 8 and a 24-week period. At first, it was kind of a maybe the bank will allow you to choose somewhere in between for your covered period. It was certainly 8 or 24 weeks. They've made it very clear now it is between 8 and 24 weeks, anywhere in between. And that applies to, again, both your first draw loans and these second draw loans. And we want to reiterate again, the identification of your covered period is extremely important as it pertains to your loan forgiveness application, because you have 10 months from the end of that covered period to apply for forgiveness. So if you have an 8-week covered period, your time frame is probably coming up in the next 2 or so months, depending on the timing of when you received your first draw loan. If you're going with a 24-week period, it's probably obviously a few months out from that. Another item that they put into the bill was related to the emergency EIDL grant. So you were allowed to take up to a $10,000 EIDL grant, and that was not to be repaid, but what they did do is build into the first round PPP that if you had this EIDL grant of up to $10,000, that was actually a reduction of your forgiveness amount. So essentially you'd end up with a PPP loan of $10,000 if you had the whole $10,000 of EIDL. This has eliminated that requirement to deduct the EIDL amount from your loan forgiveness. Again, if you already applied, they actually have a mechanism in place to reimburse you and reimburse the lender for that amount. So they will be remitting payments for the $10,000 for whatever amount and interest to the lenders. If there's any amount left over, you'll actually get a check back from the lender for that amount. I would guess that would be small, if any, as most of you probably didn't pay that back if you had that. So yeah. And again, that's a going forward and going back piece. They are opening up Another great question that we've been hearing a lot about is if I have a loan less than $150,000, do I still have to do all this complicated paperwork? And the wonderful answer here is no, you don't. They've made it very, very simple. It's now a one-page attestation that they're, I've yet to see, I don't know if Mark or Lynn or anybody, if you've seen it yet. I have not.
No.
So they've yet to release it, but what they said is going to be on it is you have to tell them what your loan amount was, tell them the estimated amount that you spent on payroll costs of that loan, and how many employees you were able to retain because of the covered loan. And you simply attest to these items, and you receive full forgiveness of your less than $150,000 loan. So within 24 days of enactment of the Act, they are supposed to be releasing the information. We're coming up fairly soon on 24 days. We have a little bit of time left. You are still required to retain the relevant records for at least 4 years related to employment, and everything else up to 3 years. The SBA always retains this right to come in and audit those loans and review those loans to ensure that there's no fraudulent activity. Again, it does apply to loans made before, on, or after the date of enactment. So essentially, whether you get first round or second round draw. This is not my general wheelhouse, being a tax-exempt person, so I'll ask Lynn to kick me proverbially under the table if I say anything wrong. So the IRS originally said that you would not be allowed to deduct the expenses related to your PPP loan on your tax returns for tax-paying entities. However, the revenue from the PPP loan forgiveness was not taxable. Congress has cleared up the fact that that's not what they intended whatsoever. They didn't want any of this to be a negative tax effect on a tax-paying entity. So now you are still able to deduct all of those expenses as you normally would any other given year, and you still do not have to recognize that revenue for your taxes. The state income tax piece of this could be different. New York State may or may not. I'll ask Lynn if she has any updates to go ahead. They may or may not be taxing this, depending on the type of tax-paying entity you are as well.
Yeah, I would just add, so right now the New York State law for us, C corporations will follow the federal guidance. So essentially, if you're a C corporation in New York State, the cancellation of debt income won't be considered income for C corporate purposes, but the deductions will, so a net negative benefit. For Article 22 taxpayers, which I know that's a little technical, which include partnerships and individuals, they indeed do not follow the federal act. So the cancellation of debt income would be included, the expenses would be allowed, but you're at a net zero. The next step is people saying, well, what about S corps, Glenn? You didn't talk about those. Well, the S corporation itself wouldn't account, right? Would follow similar rules to C corporation and not indeed include the cancellation of debt income as income, but allow the expense. But if you're an individual of an S corporation shareholder at this point in time, we do believe that that adjustment of bringing the cancellation of debt in as income will need to occur. We are actively lobbying with New York State to highlight the differences that exist and in all reality, the unfairness that exists between entity types. So we will continue to do that. The only other question I've seen a couple times roll through, and I can't see everything, I'm not that good anymore with my eyesight, but one of them was, well, what if I applied, I was eligible, I got a $200,000 loan, but I only was able to use $160,000 of those funds and get for forgiveness? Does that mean I can't go into the second draw? I think that's a great question. I initially would say if you were eligible for the first, it shouldn't preclude you from being eligible for the second. But I would go back and look at those closely about them expecting you to be able to utilize your funds and whether that might prohibit you.
Yeah, you have to have used or will use all of those funds. And since PPP closed on August 8th, I believe quick math tells me your 24 weeks is probably up. So it should be very well known. I don't know anyone that received a loan as late as August 8th. Maybe there's someone on the call, but it shouldn't be a question of if you have used or will use all your funds. I mean, you should have used them all.
But if you now have all these additional categories of expenses that might help you with the 40%, it might take a revisit.
But a lot of questions we're seeing are that we've already applied for forgiveness. Is there a way to amend or go back? Currently, the answer to that is no. There's no mechanism to amend your forgiveness application. If you've received forgiveness, there's no mechanism to go back and change what you submitted. If you haven't, then obviously this opens up the opportunities for you. A lot of questions on gross receipts before we move away from PPP. A lot of these are obviously industry-specific, type of entity-specific. Any additional guidance on gross receipts, the gross receipts test, what's included, what's not?
I would just highlight that the gross receipts test when we're under the PPP loans is different than the gross receipts test for the employer retention credit. The gross receipts test for the PPP loans, we actually just solicited or pushed out an article yesterday that gave you the segment from the SBA guidance. And as Mike and I were viewing that, we noticed that long-term capital gains would not be included in the PPP gross receipts test. On the other hand, for the employer retention credit, your gross receipts test will be determined based on some tax law language. And so you could come to a different result.
And I will say for the nonprofit tax-exempt folks that are on, it is a little bit contradictory to some of the guidance that they released as far as using your 990 revenue for that gross receipts test for PPP. So it's a little counterintuitive because they say these gains would not be included. However, those are included in your revenue in 990. So we have to kind of take a little deeper dive into that, but it's a little going against each other.
And the other interesting part is that for the PPP, they make it specific in the SBA guidance that the PPP funding is not includable in your gross receipts test, and I've seen these pop up through the chat. A lot of people are saying, well, what about my HHS funding? We remind everyone that for both the second draw PPP and the ERC, it's a quarterly test, so there might be some close analysis that has to occur in order to make sure you're really capturing the transaction of the quarter. I'll leave it at that.
I won't quite leave it at that. The other thing that we do see for PPP is you follow your basis of accounting that you report on annually. So if you're an accrual basis taxpayer, you have to make sure that that quarterly report that you're looking at is on the accrual basis. Not every entity does a quarterly accrual. Many just do it at the end of the year. So you're going to have to think about that, and that could affect the timing of when you recognize certain things.
And I think, so someone just said, what year would I record my cancellation of debt income on? And again, I reiterate what Mike just said. It's going to be dependent on whether you're accrual-based taxpayer, cash-based taxpayer, whether you've applied and received forgiveness, whether you haven't. So there's a lot of facts and circumstances that will come into determining that.
As for the timing on applications, right now, most of technically I think the timeline is that they would be open today or yesterday, but there's obviously, the SBA and the law itself pushes to make sure this PPP is made available first for underserved communities. The CDFIs are able to access first. So you should be receiving regular correspondence from the financial institutions that you used the first time for your loan. And most of them have seemed to be on top of it and all over it. So I would just continue to await guidance. But a lot of people are worried about funding running out, those kind of things. I don't know. I don't have that same concern because I feel that last time around there was about 649 billion after they re-upped the funding. There ended up being about 130 billion left. This time it's more limited by dropping the employee count from 500 to 300. There's some affiliation rules that changed as well. And then there's the 25% reduction in gross receipts. So it would seem that the pool of borrowers is smaller. I don't anticipate there being a run on the bank as there was with the first round.
I would say, I don't necessarily disagree with that, but I would say the pool of borrowers is smaller for now. and I am not sure what the next stimulus bill might do to open up that pool. So, I'm an accountant, I'm conservative, I qualify, I'm knocking on my big store.
There's certainly that concern, and the whole moving goalpost thing we talked about. I've seen some idle questions in here as well. Just a reminder, this only relates to the $10,000 advance, and that was for smaller businesses, $1,000 per employee. And that had to have been reduced from your eventual forgiveness. That was under the original rules. Now, they said that, no, that's not the case. The banks will receive payment of that amount plus the interest, and you will receive all of that back as forgiveness. So, keep on
unattached to your second PPP draw. It's not related to that.
Correct. And there's nothing you have to file. You don't have to go and claim it or complete any paperwork. This is supposed to all happen seamlessly in the background. So be on the lookout, but if you don't hear anything from your lender, then you could eventually reach out. But there's nothing you have to go and claim. And then the only other question I have, if you did not receive a first draw PPP loan and you were eligible, can you go back and apply for one now?
I think the answer is yes. Yes. Yes.
And since you cannot apply for one, a second loan, if you don't have a first loan, the first draw PPP is really the only path for you.
Correct. And the other thing I see a lot, we are sending a copy of these slides for anyone who's on the presentation. You'll get it with the recording when we're completed. Okay. So I think the next piece has to do with us switching gears a little bit, and we can go to the next one. We don't need to see that. Regarding the employer retention credit. I just want everyone on the phone to realize that this is major. You need to analyze it. I don't personally feel like businesses have grasped onto the fact that these are major dollars and that they now have kind of lifted the sanction for you to be able to get into them. So the first question, Lynn, why are we just talking about this now? It's not that we're just talking about it now. The employee retention credit was passed with the CARES Act, but it was very strict in that if you had a PPP loan, you couldn't go after the employee retention credit. And what happened with this act that was passed in late December is they said, no longer is that the case. Even if you receive PPP funding, you can also receive the employee retention credit. Now, we have to be careful, and I saw some people say, can we talk about the double dip? And we joke internally that this could be the triple or quadruple dip that we are now dealing with. It does make things more complicated, but as you will see when Rob gives you an example, it is significant and should be clearly evaluated. I'm going to tell you that the employee retention credit rules for 2020 are different than 2021. We're going to do our best in the next 15 minutes to walk you through these differences, but I would also caution you that this is complicated, and we could have a 2-hour presentation on just this alone. So it's important to be working with your advisors as you're going through this. So the first question I'm going to address is, how do I qualify for the employee retention credit? So the one of the items that I think is interesting is a lot of people get confused because there's different ways you approach this credit. But if I have 1 million employees, I still can potentially fall into being an eligible employer for the employer retention credit. The difference is not all of my wages might be available, but whether you're an eligible employer or not is indeed your first test. And so your first test is an OR test. So we get that a lot too. Do I have to do both of these? You only have to do one of these. And one of them is, are you fully or partially suspended during the calendar quarter due to orders from an appropriate governmental authority? And we'll see on the next slide, that can be federal, state, or local. The second test, so if I'm not fully or partially suspended, I can go to test 2. And the next test is, can I show when comparing a quarter from 2019 to 2020 that I had a significant decline in gross receipts? And as we go through this, I think you're going to see that 2019 might be a little hard, 2020 might be a little bit harder to get into. 2021 2021 is pretty open. And so we're going to talk about how the act that was passed in December really kind of loosens up the requirements. But again, we really need to evaluate whether your business can qualify for this credit, which is significant in the 2020 or 2021 year. So next slide. Here we're just pointing out the different types of governmental orders. I would point out to you that, just because you voluntarily suspended your operations, that is indeed not get you into a full or partial suspension. I also know, because we're an essential business and we've taken a fair amount of discussions around essential businesses, I'm going to give you this at a high level. You will hear the general rule is that an essential business cannot have a full or partial suspension. Not necessarily untrue, but there are exceptions to that rule. So, for example, even if you're an essential business, but a portion of your business had a full or partial shutdown, that resulted in more than a nominal effect. Now, I know everybody's going to say, well, Lynn, what's nominal? And I'm going to tell you, I don't know. They didn't define it. But for us, when we consider about, for example, the best for me is a hospital. The hospitals are essential businesses, but their elective surgeries were shut down. I would assume, without calling out any specific hospital, but just knowing what essential elective surgeries are, that that's more than a nominal portion of your business. So that, to me, would give rise to us potentially having a full or partial suspension for an essential business. On the other hand, we all love our Wegmans, and we still will. Wegmans was also an essential business, and they might have had to shut down their hot food line, right? We can't go in there and just grab hot food anymore. Well, yes, that was a partial shutdown, but it wasn't more than nominal, right, to their business. And so that would not be. So those are two great examples. The other thing that I think a lot of businesses are missing on this is, even if I'm not full or partially suspended, if my supply chain is full or partially suspended so that I am unable to get deliveries, that could indirectly allow you to be fully or partially suspended. So we've talked to some of our manufacturing groups about that as well. Please make sure you understand aggregation rules do apply in this setting, which are under the Internal Revenue Code and not under the Small Business Administration. And then the last thing I would point out is, if you were, just because you had to move to teleworking, if your businesses were still operational, then that is not a full or partial shutdown either, because you were operational, you were just operational from telecommuting. So that's the full or partial shutdown. That's test one. Here's the second test. The second test is the significant decline in gross receipts. And so that what a significant decline in gross receipts is for 2020 versus 2021 is different. So as you could see, in 2020, under the CARES Act, they said when comparing your 2019 to your 2020 quarters, did you see a significant decline in gross receipts, which for me to get into the ERC in 2020 is that I had greater than 50% decline in my gross receipts when comparing. So in one quarter, maybe in 19, I had 100,000, and in 2020, I'm down to 40,000. I'm in, okay? And so the first thing I would say, not only are you in for that particular quarter and for the entire quarter, you're in until the quarter in which your gross receipts for the same comparison rise to show less than a 20% decline. So I would, even if I don't show in quarter three another decline in gross receipts of greater than 50%, I still can be in quarter three as long as I don't grow up to be within the 80 to 100% range. And I'll show you that in a second in an example. But in 2021, they redefined it. And they essentially said, you know what? A significant decline in gross receipts now is when you're comparing 2019, and we'll talk about what you're allowed to compare it to, where you only have shown a significant decline in gross receipts of greater than 20%. So that's really different, and that's probably going to open up this credit for a lot of people. Again, there are aggregation and single employer rules that you must be utilizing when assessing these gross receipts, but two very important tests and very different between 2020 and 2021. So for all of you out there, right, we know what our 2020 is. We have an idea, right? You might say, well, we have this discussion. Do you include long-term cap gains? Do you include your PPP funds? Gotcha. We all have to get through all that discussion. But in general, everyone on this call should be saying, here are my quarterly gross receipts for 19, here are my quarterly gross receipts for 2020. Did I have a decline of greater than 50%? Okay, so obviously in this example, quarter 1, we did not, right? But quarter 2, we did, right? We had a greater decline than 50%. And then again, in my example, as I previously was explaining to you, in quarter 3, I still get to stay in it because I haven't gotten, right, to that point where I'm at greater than 80% of my gross receipts in my comparative testing period. And then in quarter 4, I pop. So here's something also important that you should realize. In the quarter that you pop, where you're above that 80% in comparison, you don't have to stop being eligible for the employee retention credit until the end of that quarter. So in this example, quarter 2, quarter 3, and quarter 4 are all in play for me to be an eligible employer. Now let's flip to a 2021 example. So 2020 you should know, right? You should have an idea. If you're hovering at 51% in an example like this, there are things that could potentially be talked about to properly represent your quarters. We had an interesting one here. Instead of booking all your AGEs at year end, do we spread them over the year like they truly result in? Is there a method of accounting change that might be in play for tax purposes? There's a lot of discussion that can happen when you're close to that percentage completion, or when you're close, to that 50% mark. So can we go to 2021? So 2021 is interesting. So let's just ignore the bottom for now, just go to the top. So the top is going to say, look at your first quarter of 2021 and your second quarter of 2021. Notice quarter 3 and 4 aren't there because under the current package, it stops as of June 30th. You can't go after the employee retention credit after June 30th. And what's also interesting is I don't compare it to my 2020 gross receipts. I compare it back to my 2019 gross receipts. Now, some of you are sitting there and might say, why, Lynn? Well, why? That's a better answer. That's a more favorable business answer to you because my 2019 gross receipts were probably higher than what I saw in 2020 because 2020 was COVID. So essentially, you can look at quarter 1 of 2021 and compare it to quarter 1 of 2019. I need to see a decrease of greater than 20%. Well, I don't see that in quarter 1, right? But I do see that in quarter 2. So under the traditional method, which you're allowed to look at, I would get an employee retention credit, be eligible for the employee retention credit for quarter 2. But what's fascinating, and I'm going to really try to drive this point home, and for a variety of reasons, and I'll explain in a second, there is an alternative test that you can have. And what that alternative test says is you don't have to wait for quarter 1 of 2021 to be done to figure out if you had a significant decline in gross receipts. You can elect to look at your prior year quarter. So as of today, everyone on this call knows whether or not they've had a significant decline in gross receipts by comparing Q4 of 2020 to Q4 of 2019. And if you saw a gross receipts reduction of greater than 20%, you are an eligible employer for quarter 1 of 2021. Because you're allowed to say, I'm electing, instead of waiting for my first quarter of 2021 to play out, I'm electing to evaluate the prior year quarter. This election to evaluate the prior year quarter is only available for 2021 and forward. Okay? So why is this so important? Why is Lynn getting crazy about this? Because if you know that you are an eligible employer for Q1 2021, and you can estimate the credit you're going to be able to receive, you can stop paying your federal withholdings to the federal government each payroll period. Cash impact now. And why is that important for us? Because what we're finding is, say you all come to us and say, Lynn, I got it in 2020. I need to go back and amend my Form 941, my payroll tax form in 2020. And I would say, great, happy to do it for you, but let me tell you, the processing time is insane, right? The ability for the IRS to process our refunds, not just for payroll, right, but for a variety of items is really slow right now. In addition, it is what it is, your payroll companies are also really, really, really slow in this process. We had one client who was looking at a large ERC, went to their payroll company, and they said, as soon as we could amend that for you is in 6 months. That's 6 months before the amendment that it gets filed with the IRS, and then you're waiting for the IRS to process it. So if you can lock down that you're eligible for Q1 of 2021 and can just keep those funds in pocket and not have to apply for them to give it back to you, it's extremely significant, and I would encourage you to do so. Again, we'll see that you can also use the prior year, your prior year quarter election for Q2 of 2021 as well. Okay, next slide.
Lynn, is the gross receipts test across all affiliated companies?
So the affiliation rules, and I hate to be the tax geek, but I will. We had this thing called the small business exemption. It was $26 million of gross receipts or less, and it would allow you to do certain things in the tax code. It's under Code Section 448. Those are the same aggregation and affiliation rules that apply here. So in the most simplest example, if I own greater than 50% of 5 partnerships, then I have to include, right, the gross receipts of all 5 partnerships when assessing my gross receipts test. So it is something that you should be aware of. Your tax advisor should have already assessed your aggregation, so we shouldn't be starting from ground zero, but we would have to then say, okay, how do we combine these for quarterly testing? So it's important. The first thing we just set out to say is what's an eligible employer? So did we have a full or partial shutdown? Yes or no? Or did we have a significant decline in gross receipts? For 2020, it's greater than 50%. For 2021, it's greater than 20%. Much easier, in my opinion, to potentially get into. So what wages are we allowed to look at? We're allowed to look at wages that you paid between March 12th, 2020 and June 30th, 2021 if you're an eligible employer. I would point out some things when you're looking at these wages. Your qualified wages are calculated at gross, right? So, before you withhold for federal, state withholdings, et cetera. But what's really interesting is they also allow you to include in that wage calculation not just the employee's portion of healthcare expenses that are paid with pre-tax dollars, but also the employer's. So say that I pay an employee $1,000, $100 of that $1,000 is used to pay for their health insurance. Well, they bring home $900, and then, less than $900 after you pay your employment taxes. But essentially, I'm allowed to look at that full $1,000, and then if I, the employer, pay another $100 in to cover that employee's health insurance, I get to look at $1,100. The other item I'm going to talk to you about has to do with large employers and small employers, and what you're going to find out is you want to be considered a small employer if possible. And if you're a small employer, then not only do you get to look at what you paid your employees for when they gave you services or didn't give you services, so when they actually worked or didn't work, but you also can include their wages for PTO, such as vacations, holidays, and sick days, if you're considered a small employer. Large employers can't, okay? And again, just like we saw that gross receipts test change between 2020 and 2021, we also see the definition of a large employer change between 2020 and 2021. So that's our next slide, I believe. Okay, so I'm an eligible employer. We know those 2 tests. I come in and I say, okay, I know the wages. Now, what do I actually get to use in the employee retention credit? Well, in 2020, if you have 100 full-time employees or less in the 2019 year, you get to look at all the wages paid for PTO, wages paid for when people conducted services, wages paid when they didn't conduct services, health insurance that you paid maybe for furloughed workers, all of it, okay? And in 2021, if you qualify as an eligible employer in quarter 1 or quarter 2, you get to look at all of those items as well if you have less than 500 full-time employees. So what's a full-time employee? The full-time employee, for purposes of the employee retention credit, is based on 2019, and it's based on a 30-hour count. So if you have a salaried employee who works 30 hours or more each week, they count as 1. And then for anyone who is not full-time or a full-time employee, you're going to gather up all their hours each month and divide by 130. And that's going to count toward each monthly employee average, and then you're going to average those months out to get a year. The next obvious question is saying, Lynn, it might be on the next slide, I think. What happens if I'm considered a large employee? Well, for larger employers, you're not allowed to count all the wages you pay. You're only allowed to look at the wages you paid for people who weren't providing services. Originally, it kind of got hairy where people said, well, if I furlough someone, I'm still paying for their health insurance. Can I still go after that for the employee retention credit if I'm a large employer? The answer is yes. It was put out in the IRS FAQs and then reaffirmed by the most recent legislation that was passed. But essentially, how I explain it for my large employers, because sometimes it's confusing, is say that I was over 100 in 2019, which would affect my 2020 credit, or I was over 500 in 2019, which would affect my 2021 credit. Essentially, think of you as a truck driving agency. Half my trucks go to the grocery store, half my trucks go to the restaurants. Well, I don't get to look, because I'm a large employer, at all my wages. I only get to look at the wages I pay someone for not providing services. The trucks going to the grocery store, still going to the grocery store, they're still performing a service for me, they're out. The trucks, on the other hand, that aren't going to the restaurants, and if I'm still paying them, or paying their health insurance because I furloughed them, they're in. So that's the most basic example that I can give you. The other item I'd just like to point out that I think some people might have missed, including myself in the beginning, is that if you have a choice between a suspension, full or partial, or a decline in gross receipts, you're going to go for the decline in gross receipts. And the reason is this. If you have a decline in gross receipts, as Mike and I were talking about it this morning, not only do you get the quarter in which you had a greater than 50% decline, even if you rebound in the very next quarter, you don't assess that until the end of the quarter. So once you're in, you at least get 2 quarters to include the qualified wages. And when you're in, you get the wages for the entire quarter. So if you always get 2 quarters, you're getting the wages for the entire 2 quarters. If you have a full or a partial suspension, that makes you an eligible employer for a specific quarter, but the wages you're allowed to evaluate are only the wages that were paid when you were full or partially suspended. Be careful, right? Because it doesn't necessarily, I've seen companies who normally, franchises that operate 24 hours, and they've been put into, you can't stay open, you have to shut down by 8, and that would count as a full or a partial suspension that could have lasted for a very long time. But in all likelihood, with our construction workers, right, we didn't see it for the full quarter, so we can only look at the time period in which they actually were suspended. So that's an important caveat. Next slide. Also be aware, and this is where we call about the double, triple, quadruple dip, that the wages you use for the employer retention credit cannot also be the wages you use for PPP debt forgiveness. And Rob's going to give you a great example on that. But that's why if you have not submitted your PPP debt forgiveness application yet, don't. Because we might want to carve out some of those payroll expenses to apply to the ERC and look for rent, look for mortgage interest, look for these new expenses that Mike talked to us about earlier to raise up to 40%. We need to maximize your stimulus funding. And by just throwing all your payroll on your PPP debt forgiveness application, that probably is not going to get you there. In addition, if you used it for work opportunity tax credits, WOTCs, a lot of the industries out there do, the FFCRA, wages can't be used twice. So these wages have to be specifically and only used for the ERC. Next slide. Okay, so here's the best example I can get you. We qualified that we're an eligible employer. We're in, right? And we're told in the most basic example, we had qualified wages of $8,000 in one quarter and qualified wages of $8,000 in the next. So what does that mean in 2019 versus 2020? Well, in this slide, what I'm trying to highlight to you is the maximum amount of qualified wages you could get for the entire 2020 year. That should say 2020 and 2021. We'll fix that before we send these out. The maximum amount of wages you could take for the 2020 year is $10,000, and the maximum credit was 50%, so $5,000. So every employee you had potentially had a $5,000 credit on their head if we could prove that we paid them at least $10,000 in qualified wages and we were an eligible employer. However, in 2021, they've increased that, and they now say it's not $10,000 for the whole year, it's $10,000 per quarter. So now I have $10,000 $10,000 per quarter, plus they say, we'll give you more than 50% towards the credit. We'll give you 70%. So again, in 2020, we were allowed to see a maximum credit of $5,000, 10,000 times 50%. In 2021, we're allowed to see a maximum credit of $14,000, 10,000 quarter one, 10,000 quarter two, times 70%. That's big dollars, folks. That's big dollars. So essentially, this is what that's showing you. So I was capped in 2020. I could only use $8,000 from the first quarter, 2 from the second. Even though they spent another $8,000 in the second quarter, I couldn't get to it because we're capped at 10 for a maximum amount of $5,000. With the same exact fact pattern, they said we paid 8 in 2 quarters. So that would be $16,000 times 70%. Now I'm at $8,000. That shouldn't say 8, should it? No. 8,000 times 70% should be, $11,200 credit. Okay? You wouldn't have believed that I went through these 2 times already, but I missed it. So, but there you go. So a lot of money hanging out there for you guys for the employee retention credit, and we will fix that before sending it out. The next slide, real quickly, this is just a reference material for you. Use it as you wish, but it essentially says what are you looking at in 2020 versus what are you looking at in the first quarter of 2021. We went through all that, so you're welcome to hang it up in your cube while trying to calculate this or talk to us about this. It helps kind of simplify things. The next slide is really important to me that I also think should be your reference material. I apologize for all those funny symbols, but essentially what I've done for our finance departments out there that are listening, we have very similar language used for the second draw and for the ERC, but the definition of that language is different. The definition for the PPP or the second and first draw is under the Small Business Administration. The definitions for the ERC are under the Internal Revenue Code. So what I've done here is I've compared for you essentially what's the difference, where do I go to find the gross receipts definition for PPP versus ERC. We've gotten a lot of questions on this. As a reminder, for your second draw PPP, your employee count of 300 or less will be based on the last 12 calendar months. I think that's a favorable answer. For the ERC, your employee count, whether you're going after the employee retention credit in 2020 or 21, it's based off of your employee count in 2019. For your employee count for PPP, it's based off an average of 40 hours a week. For your FTE calc for the employee retention credit, it's based off of 30 hours a week. It will get confusing. We are here for you. I'm going to pass it over to Rob now to go through a great example about highlighting the double dip between the PPP and the ERC.
Great. Thanks so much, Lynn. And I know when I've been just kind of reviewing all of the changes that have happened with this particular stimulus package and knowing that there's PP1, PP2, there's old employee retention credit, there's new employee retention credit. Some of the rules apply to back, some of the rules apply to go forward. I know after the last presentation, I know my head was spinning, and so I figured probably to go through a case study, an example of exactly how the different programs work, both the prior PP1 and PP2 and how they interact with the employee retention credit, I think would be helpful. So I selected a business that was specifically shut down or partially suspended during 2020, and I think this just shows a good example of how all these rules apply. And it happens to be a fitness center, obviously a fictional company called Muscle Mania Fitness Center. And I think if any of you are members of a fitness club or the YMCA, this particular industry has been especially hard hit with all the changes in rules and et cetera. So I think it's going to be a good example. So in this case, we have Bobby Bicep, who happens to own a couple different Muscle Mania fitness centers, and he employed 40 people prior to the pandemic. So on March 16th of 2020, fitness centers, exercise facilities were essentially fully suspended by government order in New York State. Cuomo came out with a governor order specifically requiring them to close their doors. And so Bobby at the time was thinking, I think I can still make a go of it even though the center itself is closed. I think what I'm going to do is offer Zoom classes for all my members. Hopefully they'll continue to pay their membership dues and I can stay open for a period of time. And so he stayed open from March 16th through May 26th. And the reason he stayed open was because he was eligible for a PPP loan, a forgivable loan, and he applied on April 1st, received the PPP loan proceeds of $312,500, and he kept everyone on payroll. And I think basically Bobby felt that even though he wasn't really making any money on this, it was just a good way to keep his people employed, and why not apply for the PPP loan, and it's better to actually pay his employees than to pay the loan back. So he kept everybody on payroll for the 8-week period. So after 8 weeks, he fully utilized his PPP-1 loan, and he basically shut his doors. He didn't think he could generate enough revenue to pay his people with the Zoom classes, so his 8-week period ended, he fully paid for everything, and he basically shut his doors. Well, so lo and behold, on September 2nd, Governor Cuomo, reduced or eliminated that suspension for exercise facility and allowed exercise facilities to open up, but only at a 33% capacity. So Bobby figured, well, I think I can make a go of it with that 33% capacity. So he brought back 10 of his trainers, and he's going to pay them $60,000 on an annual basis, or $15,000 a quarter. So if you're thinking 10 people, $15,000 a quarter, that's $150,000 of wages a quarter. And so Bobby figured he'd give a go of it. And so on October 1st, he really didn't listen to Bonadio. He said, I just want to get this forgiveness application over with. He went forward with it. It got approved. He was forgiven in full the $312,500 on his PPP-1 loan. So on December 27th, the new stimulus bill passes, and now Bobby's saying, okay, Rob Bonadio, what can you do for me now? What should I do with the new stimulus package? Next slide, please.
I was so into that story.
So, Multi-Mania Fitness Center, these are kind of the facts. And so if you look at, obviously the key items are payroll and sales, everything that Lynn kind of, and Mark and Mike went over. And so if you look at the 2019 payroll compared to the 2020 payroll, this just gives you an idea of the changes in his payroll throughout these periods. And so if you look at Q2, the $260,000 of payroll, that was essentially when Bobby had received the PPP-1 loan, kept his people on payroll through the end of May. So he spent about $260,000 on payroll for that period. You can see Q3, he basically was shut down until September 2nd. So essentially what ended up happening is he brought people on September 2nd, so he has some payroll that he actually paid for in Q3. And then you can see in Q4, he brought 10 of his trainers back, paid each of them $15,000 a quarter or $60,000 annual salary. So his salaries for Q4 in 2020 were $150,000. So the key numbers to kind of look at in terms of eligibility, whether it's for PPP second draw or the employee retention credit, whether it's the employee retention credit for 2020 versus 2021, are the revenue numbers, right? The gross receipts. And so you can kind of look at his business in particular was pretty much decimated by, the pandemic. You can see the first quarter was pretty flat. He was down about 8% in revenues. Nothing really happening there. It was towards the end of the first quarters when the pandemic hit, and so that's why his revenues dropped a little bit. You can see in Q2, when he was shut down theoretically on March 16th and was just doing the Zoom classes, he still lost a lot of members. You can see his revenue was actually down almost 67% from Q2 of 2020 compared to 2019. So again, keeping in mind, some of those revenue reduction numbers, the 50%, in 2020, with old ERC, the 20% reduction, with new ERC, thinking about the PPP loans, the 25% reduction. He seems pretty well good to go on all of those issues. So you look at Q3, his revenue's way down, 83%, because he was pretty much closed for most of that quarter. And then Q4, again, started bringing people back. He was open, but still really not generating the kind of revenues that he did before. So he was down about 65% revenues in Q4 compared to Q4 20 compared to Q4 2019. So you can see Bobby's still struggling a lot, but I think the good news is there's a lot of opportunities here, in particular for all three quarters in 2020 compared to 2019. So let's go through some of the issues on the next slide. So PPP first draw, Bobby felt that everything was right. He submitted everything correct. He didn't really have any changes. So he's all done with PPP first draw. Been there, done that. PPP second draw, 25% or more reduction in gross receipts in any quarter of 2020 compared to 2019. Slam dunk. He had a number of quarters that was well in excess of 50%. So he's all set for PPP second draw, and he wants to know when he needs to apply. Employee retention credit. Here's a little bit more stringent standard. The old employee retention credit, he needs to satisfy that 50% reduction in gross receipts from 2020 to 2019. He also qualifies based on the full or partial suspension due to the government orders. But as Lynn mentioned, if he's good with the gross receipts reduction, that's probably the best way to go. And then obviously for the new employee retention credit for 2021 and forward, he's even in better shape because he only needed that 20% reduction in gross receipts. So he's looking pretty good. It seems like he's going to qualify for everything. Next slide, please. So let's just go through the details a little bit more. So as I mentioned, he experienced a drop of 50% or more, and he has less than 100 FTEs in 2019. So essentially, he's eligible for the employee retention credit going back to 2020, pretty much for the second quarter, the third quarter, and the fourth quarter of 2020. Now, his problem with the second quarter was he had a PPP loan. So he can't, and he counted all of those wages in the PPP first draw towards PPP. So he's not eligible for the employee retention credit for those wages. Those wages would not qualify for the employee retention credit. So he skips Q2, but he kind of looks at Q3 and Q4 now, and he qualifies for both of those quarters. So what he's able to do is actually take the credit for those wages paid in the third and fourth quarter. So if you went back to the example, you'll see that he actually paid 10 people a total of $40,000 in that Q3, so you can kind of see it in the 2020 payroll. So he's eligible for the credit. The credit's 50% of the $40,000, so he's eligible for a $20,000 credit going back to the third quarter of 2020. So for the fourth quarter, since he used up all those wages in the third quarter, so the fourth quarter he's also eligible for the employee retention credit for the fourth quarter. But the thing that you have to remember is he has those same 10 people on payroll for the third quarter as the fourth quarter, and you're only eligible for 50% of wages up to $10,000. So if you recall, those people were being paid about $15,000 a quarter. So essentially, he ends up being maxed out at the 10 people for $10,000 a quarter and 50% of that. So it's essentially a maximum credit for the whole year of 2020 of $50,000. And from the example, you can see he took $20,000 for the third quarter, so he's eligible for another $30,000 in the second quarter. He's eligible for a $50,000 credit. So basically what he can do is he can amend his third quarter 941, go back, claim a refund. As Lynn said, it's going to take some time. He also could just look at the fourth quarter, not apply for the third quarter, just look for the fourth quarter, and essentially, since the 941 hasn't even been filed yet for the fourth quarter, he could just report the credit on his fourth quarter 941 and essentially get a refund of the $50,000 in taxes that he paid for the fourth quarter of 2020. So he's really in great shape with the employee retention credit for 2020. Now let's look forward towards 2021. So basically, Bobby Bicep is looking at it and he's saying, geez, I don't know what's going to happen for 2020. But as Lynn pointed out, he has the option of electing to use a prior quarter for 2021. And since he knows he's already qualified for the fourth quarter because he had a significant revenue drop in the fourth quarter, well in excess of 20%, he decides, well, I'm going to use the fourth quarter of 2020, for that first quarter of 2021. So he's eligible now for the first quarter of 2020 for the credit for the employee retention credit. Now the credit, as Lynn pointed out, is much more lucrative. It's gone up to 70% of wages. So he can claim 70% up to the $10,000 per employee for the 10 employees that he had on staff in 2020, and so it comes out to $70,000. So now he's eligible for a credit of $70,000. He could request in advance of that, or as Lynn suggested, he could just simply stop paying his payroll taxes for the first quarter. And again, usually with most employers, the 70% is going to exceed generally the amount of taxes that you're going to deposit during a period of time for the same wages. So Bobby's he's in really good shape. Now he's kind of saying, well, I really want to apply for that PPP loan. It was such a good deal with the first draw that I had. So let's go forward on the PPP 2 draw, second draw. And so the concern we have is we know that we're already picking up all those wages from the first quarter, at least we intend to, for the first quarter of 2021. So what do we do with PPP second draw? So basically the plan that we've laid out for Bobby is let's plan on applying for our PPP second draw on March 31st, 2021. That's the last day, that he can apply for the second draw, at least right now with the legislation. And so he can wait till March 31st, and as Mark said earlier, he didn't think we were going to run out of money. So just remember what Mark said. No, just kidding. So really, he's going to apply on March 31st because he knows, any wages that he spends under the PPP2 program is going to happen after that period of time. So he has a 24-week period now. That ends on September 14th of 2021. He's going to use the same 2019 payroll that he did before, so he's going to have a second draw PPP loan of $312,500. And so the other strategy that he can consider too is starting to look at, using, the non-payroll costs and also looking at whether he would be eligible for the employee retention credit for the second quarter of 2021. And so you got to kind of look at that as well. And so he's going to have a real opportunity in that second quarter to kind of look at, okay, how much in wages am I going to pay in that second quarter if I use up all of my PPP loan by using some of those non-payroll costs? Maybe I have some other wages that I can use the employee retention credit for. So at a minimum, it looks like, Bobby's going to be eligible for, certainly was eligible for PPP1. Looks like he's going to be eligible for the employee retention credit for 2020 and first quarter of 2021, and a PPP second draw for 2021 as well. So let's go to the next slide that kind of summarizes basically where Multimania fitness center ended up? Actually in really, really good shape. I'd say he probably hit the, I don't know if you'd call that the quadfecta, instead of a trifecta, or maybe hit, 4 different things. You look at it there, and basically what we're thinking that Bobby's going to end up with, he got the first draw, PPP loan. He received the employee retention credits for Q3, Q4, $50,000. He's going to get the $70,000 we know because he already experienced that revenue reduction in 2020. So as long as he keeps those people on payroll, he's going to get the $70,000 of employee retention credits in Q1 of 2021. He potentially could get even another $70,000 of employee retention credits in Q2, although I'd say it's probably unlikely that he would get all of that because of his PPP second draw. But again, with the PPP second draw, he can also choose to bring more people on the payroll to fully utilize the PPP second draw so that maybe he can free up the payroll to be used for the employee retention credits for that second quarter. So you add up all these numbers, and and really Bobby Bicep is sitting pretty. $815,000 of basically government subsidies that he could possibly obtain over this period of time is going to make a huge difference in the success, long-term sustainability of this business. So you can see in this situation it worked out really well. I think most organizations certainly should be able to take advantage of the employee retention credits with that 20% drop in revenues. But I think this gives you a good example of kind of having your cake and eating it too with PPP and the employee retention credit program.
I think this is a great example of why you need to work with your advisors. Okay, there's a lot out there to maximize, and this example shows us. Originally, our this Muscle Mania Fitness Center thought they could get $313,000. And by working with advisors and staying on top of new legislation, we're up to $815, with that possibly being even expanded more with the Biden additional stimulus bill. Just 2 quick things. A lot of questions I see floating about how do I get it. It's on your Form 941. It's your payroll. You don't have to wait until you file your income tax return or your 990. It's there now on your payroll. You do, if you have a payroll provider, will need to work with them or file your own Form 941 if you don't want to wait for their time period. And it also is asked, can the ERC be used for not-for-profit entities as well? And the answer is yes. So this is for everyone, not just for tax-paying entities. So I think we're going to, right now, because of the essence of time, this is a large topic and we need to address it. So I think we're going to move over to the Shuttered venue with Jeff.
Thank you. We'll go through this, again, in the interest of time, relatively quickly. On top of everything that we just talked about, the new law that was signed on December 27th also includes this other new program called the Shuttered Venue Operator Grants. It's very specifically targeted at live venue operators or theatrical producers, museums, motion picture theater operators, and talent reps who would be involved in that type of industry. You may have heard of this as the Save Our Stages effort. There was a lot of talk about that as we went through 2020. This is the result of the Save Our Stages, and they called it in the law the Shuttered Venue Operator Grants. So if we go to the next slide. If you're in one of these categories, if you can fit into this, it can be quite lucrative. How much can the grants be? Up to 45% of your 2019 gross earned revenue, or $10 million, whichever is lower. Now, one of the frustrating elements of this at this point in time is that this term gross earned revenue has not been defined in the law. We're awaiting the regulatory definition so that we can actually execute some math on some of this to figure out what these numbers actually look like. The other thing with the Shuttered Venue Grant Operator or grants is that you can get a supplemental grant for 50% more if you use the first grant and there's still funds available under this program after that. Next slide. So for what time period can these be used? Again, this is totally separate from the other things we've talked about today. This has a 22-month time period to use from March 1, 2020 to the end of 2021. And if you get the supplemental grant, it goes another 6 months past that. So there's an extended period of time to use these funds should you qualify and be able to get them. We go to the next slide. So what can you spend it on? The list of things you can spend it on is much longer than the list for PPP. although most of the things that you could spend a PPP loan on are also eligible for the Shuttered Venue Grant. A couple of the things that are noteworthy is that payments to independent contractors up to $100,000 per person are included as eligible for the Shuttered Venue, and also a lot of this sort of operating expenses, maintenance, licensing, operating leases, those kind of things. The list is quite extensive, and we won't lay out all the things here, but there's a lot of eligible costs that you can use to justify the use of these funds.
Is there a requirement like the PPP that 60% has to be used on payroll?
No, that's a beautiful thing too. There's no minimum. Like on PPP, you have to use at least 60% for payroll. There's nothing like that in the Shuttered Venue Operator Grants. So you do not have to worry about that, and you can really apply it to any of these costs in whatever proportion makes sense for your operation. That also would free up your payroll costs conceivably under a logic like we just saw in the ERC example. If you want to use your payroll for the ERC and apply other things to this, that's a viable option in terms of your strategy.
And just for, again, the ERC for not-for-profits, you don't pay income tax, but you pay payroll tax, so you're offsetting your payroll tax.
Absolutely correct. So, next slide. So, to qualify, you have to not only be one of those 4 types of organizations, but you have to meet these elements. Fully operational on February 29th. This gross earned revenue of a 25% reduction, and again, that same term, gross earned revenue, is not defined yet, but we'll figure out what that is shortly as they issue the guidance. You have to have reopened or have a plan to reopen, and then you also have, this, by the way, is a totally separate calculation of FTEs. You have to have no more than 500 employees, and it's calculated in a way that's very unique to the Shuttered Venue Operator Grant Program. Anyone over 30 hours a week is 1 FTE, and anyone between 10 and 30 is a half a FTE. And that's how you have to calculate it for this grant, for the purposes of this grant alone. Not to be confused with all the other ways you calculate employees and FTEs for all the other things. Next slide.
So,
go ahead.
Jeff, real quick, and maybe you get into this, but a lot of people in a hurry to go out and get PPP2 when that opens up. And obviously, if you have a PPP2 loan, you can't get the Shuttered Venue Grant. I see tons of questions that are likely of a legal nature, asking, is my entity an eligible type? This is what we do. Does it fit any of the 4 categories? Do you anticipate that the guidance that comes down on this will further define who falls into which bucket?
There's definitely a lot of questions about that, and yes, we do. The SBA is obligated to issue regulatory guidance on this in the next few days, actually. So we anticipate that'll come out. They have this habit of issuing it late in the evening on a Friday, perhaps. So I'm kind of thinking Friday night is when it's going to come out.
Or right before a holiday.
But yes, we're getting a lot of questions like, is a minor league sports team eligible for this? Probably not, based on the way the law is written. Is a zoo eligible for this? They probably are, based on the definition of a museum that's in the law. So some of these things we believe will be clarified. There's a lot of questions about that in terms of eligibility. And Mark's point is a good one, and it's on the coming slide. You cannot have a second round PPP loan and a Shuttered Venue Operator Grant. You have to pick one or the other. Strategically, we know there are organizations who are going to apply for both. That's their plan anyway. And as the way it's written right now, that's not prohibited. Apply for both, figure out which one ends up being more money for you or a better answer for you, and then turn down the other one. I can't tell you that's wrong based on the guidance we have right now, although there's some risk to that. You have to make sure you're managing those applications.
Well, as soon as you apply for your PPP2 loan and the bank submits it via the Form 1502 to the SBA, you're in the SBA system as having applied for a PPP2 loan.
Oh, yes.
And the way that...
It's silly to think that the governmental systems do
Yeah,
not
because it's...
No, it's the same agency, right? Is this
they're both through the SBA, and the way the law talks about it is you can't accept both of them. So it doesn't say you can't apply for both of them. This is why I can't tell you it's wrong, although it seems like it probably is. We're not recommending that you do that. I'm just saying that that's an inevitable question, and we've been asked it many, many times already. So that is a strategy that people are thinking about. But again, until we get the more regulatory guidance on the Shuttered Venue Grants, we would recommend that you wait on that. There is also this prioritization in the law. If you can show that your gross earned revenue declined by 90% or more between this 9-month period of April 1st and December 31st, 2020 versus 2019, you get first dibs. And in fact, the SBA is only allowed to accept applications or consider applications from those organizations with a 90% reduction for the first 14 days. For the next 14 days, they can accept applications from organizations with a 70% or greater reduction in gross earned revenue. And after that, then anybody can apply regardless, if they're eligible, regardless of their gross earned revenue reduction. So they do prioritize those who were hardest hit, in theory, by this, based on this gross earned revenue evaluation. Also, they set aside $2 billion of the $15 billion for organizations with fewer than 50 employees. So how the SBA is going to adjudicate that, we'll have to see how they execute it. Next slide. So there are some things that disqualify you. So it's not all movie theaters and not all organizations who meet those 4 criteria. If you're an issuer of securities on a national securities exchange, you're out. So I've had conversations with local independent movie theaters who say, there's no way I'm going to get any money because the big theater chains are going to eat it all up. That's not true, because those folks will be excluded based on some of these rules. Also, the one about operation of venues in more than 10 states is an interesting one. If you have a chain and you're in more than 10 states, you can't apply for this. And then the last one there, receiving a second round PPP loan excludes you from the Shuttered Venue Operator Grant Program, as we talked about. So if we go to the next one, there's other eligibility criteria, and we're having a lot of detailed conversations with organizations about some of these things. We're not going to go through all this now. I will tell you that the SBA has not issued the guidance that clarifies some of the words that are actually in the law. We do expect that soon, and we joke about Friday night at 10 p.m., but I do anticipate it's going to be relatively soon that comes out. And on the next slide, just a comparison, because organizations are saying, how do I choose if I want to go for the second round PPP or the Shuttered Venue Grant? The biggest differences are the ones on this slide. The Shuttered Venue Grant, the amount is 45% of 2019 gross earned revenue, up to $10 million. Second round PPP loans are capped at $2 million. That could be a difference maker. We're talking to a couple larger organizations within this eligibility criteria who are probably looking at a Shuttered Venue Grant of $6 to $7 million, and a second round PPP would only be $2 million because it's a cap. So that's a major consideration and something to think about. The allowable period of time to use is much longer with the Shuttered Venue Grant, as we discussed. The allowable expenditures list is much longer. There's a lot more eligible expenses, and there's no minimum payroll percentage like there is for PPP. And we get a lot of people are concerned about, well, there's only $15 billion in the Shuttered Venue program. Isn't that money going to, get used immediately and it won't be available? Well, the number of organizations that have the opportunity to apply for this is very, very limited. So $15 billion will go a lot farther than you might think. And the second round PPP, there's a lot more money in there, but since every type of organization can apply, that money theoretically could run out first. We don't know, we can't predict that. But I wouldn't be afraid of relying on the Shuttered Venue Grant program simply because there's only $15 billion in it, because it's going to be spread out among a much smaller population of organizations. So again, that was relatively quick, but we want to make sure we have time for some Q&A here at the end.
It's a big opportunity. The grants are a big opportunity, and we're seeing a lot of people, as Jeff said, say, if I can get in that's probably going to be my cup of tea over the second PPP. I just want to clarify C1, which is a very valid point. They said, I thought we were talking about 300 employees to get into PPP, not FTEs. The employee count is still done the same way. The FTE count comes into play with debt forgiveness, because remember, if you had a significant reduction in FTE, it could reduce the amount of the debt you're allowed to be forgiven. So hopefully, I apologize if that was unclear.
And that's a nose count, like every single person you have.
For the employee count, for
qualifying for the 300 threshold.
I believe so.
That's head count, not FTEs.
Yep, and then for PPP second round, it's the prior 12 months prior to application, which I think would be more favorable than looking at 19. For ERC, it's not a head count, it's an FTE count based on 2019.
A lot of people have asked about, PPP round one. You've had the alternative size test, certain next. I can't say that word. NAICS codes, higher thresholds. Anything that we've seen like that out there now?
So NAICS thresholds still for 72, so hotel and food accommodations, for purposes of two benefits. One is you can have multiple locations, and the 300 employee head count is counted towards each location. And then also, instead of only getting 2.5 times your payroll, your annual compensation payroll, average payroll, you get 3.5. So there are some benefits for the NAICS Code 72 food and accommodation services, hotels, restaurants. I know Rob's probably sent 12 emails on it. We have some clients who are very interested. The different ways to get into the original PPP funding have been purposely eliminated. We heard from lobbyists on DC that was purposely not included in the final bill. It really, I mean, besides the NAICS Code 72, I don't see any alternative side standards for the second draw. Do you agree with that?
Yeah, and our understanding from talking to various associations and lobbyists is essentially they just kind of ran out of money. You know, for this particular bill, they only had about, approximately $900 billion. They knew if they put in the alternative size standard and some other opportunities that a lot more organizations would have been eligible and they wouldn't have been able to keep it under $1 trillion. But I think, as Lynn pointed out, I think there's going to be opportunities going forward because they recognize that some of these mid-sized companies are hurting as well and could use stimulus dollars. So you'll probably see that maybe in the next round.
Yeah, and I've also seen multiple times on the chat, our 501c3 organizations available for ERC, waving my hands, yes, you are. Don't leave it on the table. You absolutely are. Another question has to do with, I already applied for debt forgiveness for my PPP. Am I fill in the blank? Not in a good place. So the point being, one, I think we all agree, we've talked about this within the firm, if you apply for PPP debt forgiveness and say your PPP debt was $200, but you just slapped $600,000 of payroll on your form just to prove, you had used the $200,000, I do think that you could argue reasonably that amount between the 200 and what did I say, 800, 600, or 400,000 could be used towards the ERC. I think that's fair play. What I don't think you could do is if in that same example, I had a $200,000 loan, I showed $200,000 worth of payroll, you can't go back now and try to carve out 40% towards non-payroll expenses, which is why for anyone who is on this call, I know everyone's antsy, right? Like everybody just wants everything to be wrapped up and done. But I think that the play here is the long run, and you have to be patient, and patience is what you need to do here. Other questions, Mark?
Yeah, so that employee count, the 300 to qualify, it's your average monthly head count of the previous 12 months.
For the PPP.
Part-time or full-time. If someone worked 5 hours, that's one person for that month that they worked 5 hours. You take your average for each of the 12 months, or over the 12 months, and that defines if you're 300 or not. It's not the day you apply how many employees you have. It's not how many employees worked, your average FTE. It's your average monthly head count, pure head count, no FTE count there. A lot of confusion, which is understood on the employee retention credit. That is not, it's not a income tax credit. It is a payroll tax credit. So your employees pay payroll taxes, you pay payroll taxes on behalf of your employees withhold money from their wages to pay federal income tax amounts. Your credit that you calculate goes against those amounts. It's an offset on your quarterly form 941. And it doesn't matter if you're a tax-paying entity or not. If you qualify, meet the qualification eligibility thresholds, and you can offset those amounts. So I know I saw at least one question saying, well, we don't pay taxes, this doesn't apply to us.
Let's give a basic example because I do think some people miss this. Let's say that after my first quarter, I have to pay $100,000 into the federal government. What part of that's my responsibility, right, for Social Security and Medicare tax. Part of that is my employee's responsibility, and then we have federal withholding and state withholdings, right? And so that whole bill is $100,000. Some of it relates to the withholdings of the employee. Some of it relates to my liability as an employer. But if I go through and I figure out for the first quarter my employee retention credit was $70,000, then essentially I don't have to pay in, I either amend or looking prospective, I don't have to pay in $100,000 every for that pay period in the first quarter. I only have to pay in 30, the 100,000 less the 70. Now some of you are thinking, well, then does that hurt my employee? No, your employee is still going to show that as a reflection on their withholding taxes for state and federal. It's just allowing you to get to the cash quicker. I want you guys to think about that because that's the reason they didn't put it as an income tax credit. Think about that. If we put it as an income tax credit that generated in 2021, the earliest cash impact you could have on it is 2022 of March 15 or April 15. It's way too far away. So they're rolling it into your payroll taxes. This is why it's low-hanging fruit, I think, for a fair number of you, but it hasn't been on people's radar until this most recent stimulus bill was passed.
Yeah, and no one was talking about it because almost 90% of the businesses, small businesses, had PPP. So they couldn't go after the employee retention credit. So it was not widely publicized, and none of your friends had it. Now this is the big opportunity. This is the area you need to familiarize yourself with. When our recording goes out, I'd focus in on Lynn's presentation and Rob's example there because this, it impacts your planning for this year. It impacts your planning if you haven't applied for forgiveness yet, and it impacts the timing of how you're going to use your second draw PPP loan. And then real quickly to the question we had on 501c6 and the gross receipts test to qualify for the 25%. Our understanding at this point is you are not applying for a second draw PPP loan, the newly eligible entities. You're applying for a first draw PPP loan, which means the gross receipts test does not apply to you.
Let me just say it a different way too. If you did apply for a PPP loan already and you were a 501c6, that is your PPP loan as of now because you weren't allowed to under the first round. So so it's not like you can now say, oh, I spent all that money in 2020, and I'm speaking on probably out of turn because Jeff knows much more of this, and now in 2021 say I'm going to go after the second round because you officially should have gotten it now and should be working through your 8 or 24-week cover period.
And I would suggest if you're a 501c6, you need to talk to somebody, whether it's someone in this room or somebody else who knows what's going on, because you were totally shut out the first round. You probably didn't pay attention to any of it, so you have a lot of catching up to do. It's not your fault, but you really need some advice from somebody who knows how this works.
Yeah, and I think, Mark, you had mentioned earlier that maybe you don't have enough time to do PP1 and PP2. And I guess I wonder, is that true? Because theoretically, if they got a PPP1 loan, let's say today, they go through their 8-week period, puts them through February-ish, end of February early, you could apply again towards the end of March, right? Theoretically.
There's, 8 to 12 weeks between now and the end of March?
Yeah.
You could, if you're able to get that loan quick enough, but most lenders are not open up yet. If you're in that targeted demographic and you have a lender that's in that targeted demographic, and you can receive your loan within the next, week, you may be able to fit the bill there.
And other people have said, if I go, I've just been seeing it, it's true. So say I want to go after the ERC, I want to get my second PPP draw, and I don't get all my second PPP draw spent exactly right. I have a little left over. That loan's at a 1%, right? Yeah. So you gotta work through these scenarios. Others said, is a state restriction a partial suspension? I'm assuming you mean for the employer retention credit. Yeah, state, local, fed, partial restriction. For restaurants, do they automatically qualify for the second PPP due to the capacity limitations allowed for dine-in? Second PPP has nothing to do with partial suspension. It has to do with 300 or less employees. For NAICS Code 72, food and hotel accommodations, you can look at each location, but then also a significant decline in gross receipts of 25%. So things start blurring here. We get it. We've been unblurring them for a little while now, but please make sure you understand what are you talking about, the employee retention credit, the Shuttered venue grant, or the second drop PPP. What about double dip issue with grant funders and the ERC?
We're spending a ton of time with mostly our tax-exempt, not-for-profit human service providers and healthcare providers on this concept of the double dip. between both the funding streams that we talked about today from federal and also from traditional or typical state funding streams for how those types of services are paid for by the state. There's a lot of considerations there, way more. We've had actually 2-hour webinar sessions just on that topic in recent months, and we probably will have more of those. But yes, you definitely have to strategize around that to make sure that you are minimizing risk and maximizing the benefit of these programs.
And with all of this stuff, your documentation is very, very key. I saw probably dozens of questions in here about specific examples of, do I qualify for a partial suspension based on X, Y, and Z? That's, facts and circumstances, as our tax people say. You may want to involve legal counsel. I've seen some people that are essential employers go out and get a legal opinion to assess whether or not they qualify for a partial suspension of business.
They were more gray. I think there is more black and white for some, so I'd reach out to your tax advisor first for consultation, and then they'll advise you to go legal.
Certainly. And the point is, there potentially is some gray area in a lot of this, in a lot of these questions I've seen. So it's very important that you document your reasoning behind all this. And with the employee retention credit, it's not like PPP where you're applying for the credit or applying for forgiveness. You're submitting it like you do with your tax return, and you're taking a position when you make that submission. It's not going to be vetted by the bank or by the SBA.
The IRS.
You could be audited by the IRS. The DOL could come back on these as well.
We don't like to mess with our payroll taxes unless we're sure.
So it's important that you cross your T's and dot your I's and make sure that everything's in line.
Jeff, I've seen it multiple times now. Do we know when the Shuttered grant application will come out? We're waiting on guidance, right?
We're waiting on the guidance, and the timeline should be included in that guidance. So we do not know that yet, but again, that's the joke that we say about they're going to issue the guidance probably Friday night at 10. I anticipate by early next week we'll know either way, but I don't know yet.
And for 501c6, what you're applying for, because this will be your first round, your amount of your maximum PPP was 2.5 months of your average annual payroll, and now it can be based on 2019 or 2020. So you don't have to prove a gross receipts. Your gross receipts isn't your funding. Your funding is 2.5 times your average annual payroll. Okay.
Yeah, and on the 8 versus 24 or any time in between, again, it's all strategizing your PPP to align best with your employee retention credit and any other opportunities that are out there for you.
HHS.
So HHS, you want to make sure that you don't preclude yourselves from those other programs and you're not, putting the double dip in play.
Okay.
We're about 10 minutes over here. Thank you all for your time. And I know a lot of you stayed on for the questions. A lot of them are obviously very specific questions. If you'd like to, entertain them further, feel free to reach out, as I know many of you have done along the way. Lynn, any parting words?
Stay tuned. We all know there's more coming, but please reach out. I mean, we want to help you through this. We want to help everyone through this. So please reach out and let us help you, or whoever your advisor is. I would say don't try to navigate this alone. Like we said, the last bill was 5,000 pages. Lean on someone and make sure, we want all of our businesses to come out equal, if not stronger, on the other side, and that's what we're trying to help you do. Any other words, gentlemen?
Thank you.
Thank you.
Have a great day.